Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
I'm Paul Sweeney.
And I'm Lisa Mateo, filling in on Bloomberg Intelligence.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we'll look at why the toy maker Hasbro is raising its full-year outlook.
Plus, we'll look at how General Motors is being impacted by President Donald Trump's tariffs.
But first, let's begin with the tech sector.
This week, tech giant Alphabet reported second quarter earnings that beat analyst expectations. Alphabet said demand for artificial intelligence products boosted quarterly sales and now requires an extreme increase in capital spending.
For more, Lisa and I were joined by Mandeep Singh, Bloomberg Intelligence senior tech industry analyst.
We first asked Mandeep for his take on Alphabet's most recent earnings.
The fact that they are able to grow their search business double digit at that kind of run rate, $210 billion plus.
Yep.
Like, think of how many incremental dollars they added just by virtue of that 11% growth in the $210 billion business. And that is where, the real strength lies with a company like Alphabet. They are overlaying Gemini across their family of apps. AI overviews is actually driving 10% more queries.
Oh, okay.
And AI overviews is now used by 2 billion monthly active users. So Google search has 5 billion monthly active users. Imagine AI overviews being used by 2 billion monthly active users. So they got the UI part right. Gemini as a standalone app has got 450 million monthly active users. Imagine if everyone started paying a $20 subscription like ChatGPT. This could become a $100 billion business in addition to search. And then YouTube, I'm not even talking about,
I'll talk about that.
All the strength in YouTube and Waymo. So this is a powerhouse when it comes to $400 billion run rate they will be at the end of the year.
So can you explain something to me? Because when the shares dropped, because they said CapEx was a little bit more, $10 billion more than expected, a little bit. How is that different for an Alphabet versus if Meta were to say that?
That's great. So look, let's frame the CapEx. $85 billion at potentially a $400 billion revenue run rate by the end of the year. That's like a 25% CapEx intensity. Meta, on the other hand, is already at a 40% CapEx intensity because their CapEx will be $70 billion at a run rate of close to $200 billion. So that just goes to show Alphabet is still far lower than their peer group when it comes to the CapEx intensity. I mean, that's just the scale of the business that they are operating. And look, I do think the ROI on their CapEx is higher because Gemini's cost is much lower than all the other large language models, including Microsoft, including Meta. They do inferencing at a lower cost. And that's the advantage of having your own chip, having your own large language model that Microsoft or Meta don't have because they rely on NVIDIA chips, whereas Google does most of their inferencing from the TPU chips. So I think that just vertical integration they have, Alphabet has, gives them such a big cost advantage when it comes to running the AI infrastructure.
Where's the company on the various regulatory issues outstanding? What are the one or two or three ones that we really got to focus on, and what's the market telling us?
So that's the biggest risk with Alphabet.
Okay.
That has been the biggest drag on their multiple, and it remains because we have a catalyst next month where Judge Mehta is going to make a decision on the remedies. And, especially that Chrome split, that's still an overhang. Now, the base case is there won't be any Chrome divestiture, but we still need to learn about what are the remedies that may come about in terms of, proposed by the judge. And that is where if they're asked to, share search data or some other type of remedy that's going to hurt their position, I think that is the big overhang.
Boy, this one, if you have a firm view on that. You buy the stock here, and there's a ton in this thing. Are people doing that? Are people making bets here? Do you think? I bet you they have to be.
I mean, the narrative is still so negative.
Right.
Everyone is fixated on, ChatGPT, my workflow has changed.
I mean, this is where Bobby Axelrod on Billions would somehow figure out where this judge is going to rule and make a bet one way or the other.
Yeah,
you know there's the Bobby Axelrods of the world out there.
I agree. I think if you can figure out decisively what the judge's verdict is going to be, the multiple wise, you could see easily a 25 to 30% multiple expansion.
Wow.
And numbers will go up for sure after print last night. But multiple expansion is like 25 to 30% just on.
And when
on
is that ruling?
That's coming up in August, September timeframe. Yeah.
It's hard to keep up with these things. I don't know how
That's
you
why-
do it, Mandeep.
That's why we got Mandeep. Wait. Mandeep's got like a huge team, global team behind him. I mean, all he does is come on radio and TV.
Do you have
and they do
interns
all the
too?
work. He's got everything.
He's got everything.
Small
So you
army.
mentioned YouTube before, Google's video site. How is its advertising still going? Still going strong?
So look, YouTube subscriptions is what's really doing well right now. So YouTube subscription growth is north of 20%. Imagine, Netflix growing 16, 17%. YouTube subscriptions actually surpassing Netflix's growth. And then you layer ads on top of that, which grew at a very healthy 13%. So ads is a $40 billion business. Subscriptions is now close to, $20 billion. And that is where you're seeing, combined cloud plus YouTube ARR is close to 115 billion. So imagine when just these two segments growing at north of 20%. I mean, it's just a phenomenal business. These two, both cloud and YouTube, and on a standalone basis, there is so much runway for growing these two segments.
Our thanks to Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst.
We move next to consumer earnings. Earlier this week, Philip Morris posted second quarter earnings that missed analysts' expectations.
The results were due to the company's Zyn nicotine pouch shipments accelerating less than expected. Separately, Coca-Cola reported second quarter earnings that beat analysts' expectations.
And this came as the company announced it was launching a new version of its Coke product made with U.S. sugarcane this fall. President Donald Trump had urged the company to do so.
For more, Elisa and I were joined by Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst.
We first asked Ken to explain why Coca-Cola is making a switch to cane sugar and if pressure from President Trump had an impact.
It certainly is in sync with what Coca-Cola has been doing for a long time, and that is keeping its pulse on what the consumer wants to do. It has a lot of assets at its disposal, and a cane sugar product is not novel to Coca-Cola. I mean, it's produced it in the U.S., largely more outside the U.S., but in the U.S. on a selected basis. So it's really just going to expand that. It may have been prompted to a degree by the president's tweets or whatever, but it's certainly in sync. Like I said, there's an audience out there that prefers sugar-based as opposed to high fructose corn syrup-based full-calorie sodas, and they're going to play into that. Most likely, it's going to be a brand Coke extension, and it's going to be sold at a premium price in selected markets to give it an aura of exclusivity, I'm guessing, to command those prices. And so it just adds a little more excitement. It's one of many things Coke is doing now on the innovation front.
So from Coca-Cola's economic perspective, do they care which ingredient they use?
Well, it depends, Paul. It depends if they can capture the premium price they're going to, price it at. Cane sugar costs more than high fructose corn syrup. Corn is a heavily subsidized crop in the U.S. They built their supply chain around HFCS because of that, and most consumers really, they don't really notice the difference. Some do, but by and large, they've grown that franchise very well. But I guess, some tourists that go to Mexico and they taste the sugar, cane sugar Coke down there, and they say, you know what, this is really good. And they want to capture the same experience in the U.S.
I'm going to Chipotle, and they do offer the Mexican soda there. Let me shift gears here. What is a Zyn patch?
A Zyn patch? I'm not sure what a patch is. I think they made a pouch.
Pouch.
The Zyn pouch is a pouch. It's an oral tobacco product. Actually, Zyn doesn't even contain tobacco. It's a synthetic product that's laced with nicotine that is a facsimile for tobacco, which a lot of people will say causes harm, and a lot of people are right. So this is a product that people can get their nicotine buzz in a hands-off kind of way, doesn't emit smoke, doesn't offend your neighbor that you're working with, and it's done really, really well. So those are the Zyn pouches that are doing really well. Yeah.
I thought it was Zinfandel, the wine. That's no kidding.
I get that pouch.
So, but I mean, it's big enough a business, Ken, that Philip Morris would call it out.
Oh yeah, no, Zyn, it's about 8% of the sales, I believe, at this point, but it's growing, at a 20-30% rate, as opposed to cigarettes, which are flat, if not down. But IQOS is their smoke-free device segment, which is doing very well. But at the law of large numbers, at some point, that's going to slow. And Zyn is filling the gap to keep the overall volumes in a positive trend. They price these things very high. There's not a lot of competition in this space. So, one of the things investors would say about the world of tobacco is because it's so consolidated, they can pass on a very high pricing. And that's what really drives the top line and, the cash flows and so on. And Zyn plays very, very, very well into that model.
And how does it fare as far as we hear about e-cigarettes, vaping, things like that? How has Philip Morris been doing competing with this category?
So they have a product called Vive, which is their e-vapor product, as opposed to what they call heat not burn, which has actual tobacco in it. And they would say is a more appealing alternative for smokers who are trying to quit. It's a lower margin product. It's kind of seen by Philip Morris as a kind of an entry-level product. For those who are trying to move away from combustible cigarettes, they can turn to e-cigarettes, a low-cost method. And their hope is that even though it's a low margin product, their hope is that they can get that consumer maybe at some point to trade up to their heat not burn product, which is a more profitable product for them.
Our thanks to Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst.
Coming up, we'll look at why the hotel chain Hilton lowered expectations for net income this year.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Lisa Mateo.
And I'm Paul Sweeney. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Paul Sweeney.
And I'm Lisa Mateo, filling in on Bloomberg Intelligence.
We move next to the telecommunications space. This week, Verizon Communications posted second quarter revenue that surpassed analyst estimates, and the company raised its profit outlook.
The results were fueled by wireless price increases and favorable tax reform.
For more, Lisa and I were joined by John Butler, Bloomberg Intelligence Senior Telecom Analyst.
We first asked John what's making the company so optimistic.
When I look at Verizon, I think of the phrase game of the inches, right? I think the improvements here quarter in and quarter out are incrementally better. They're edging towards that acquisition of Frontier, which is really going to change the game for them. But in the meantime, they put a lot of changes in place in terms of their go-to-market strategy, how they're combating promotions coming from T-Mobile and AT&T. And on the margin, quarter in and quarter out, I just see them doing a better and better job. I think all the actions they've taken are starting to work. And so taking the long view here, I really think Verizon is improving just quarter in and quarter out. And this was another quarter where you could look at it in isolation and say, it was a solid quarter, a little bit mixed on some of the metrics, but I think on balance, better than last quarter and last year.
John, what's kind of the positioning of Verizon in the marketplace? Like, I've been a longtime Verizon wireless customer since the beginning of cellular service, actually. And I guess I was initially drawn to it because I thought they had the best network, so quality. Is that still the case? Because it seems like, I don't know, T-Mobile's gotten a lot better in quality and AT&T, I don't know.
Yeah, Paul, you bring up a good point. I think there's a question mark out there as to whether Verizon still has the best network versus T-Mobile and AT&T. But I think they have a slight edge there in terms of coverage. And it's interesting. A lot of people ask me about wireless, who has the best network, who should I choose? And the one thing that people are always asked about is how's their coverage. I think coverage is very important to people. And I think when you think on that metric, in terms of that metric, Verizon delivers the bars on your smartphone probably more than T-Mobile and AT&T. In terms of download speeds, though, I suspect that T-Mobile probably is gaining the edge here.
Now, what about prices? Did Verizon increase their prices? If so, did that help?
So we did see all the carriers are increasing prices right now as the market matures and new user growth is slowing considerably. The only way you're going to grow that important service revenue metric is by raising prices. They tend to do it on older plans. Verizon's done it over the past 6 months, as if you look over the past year, so has AT&T and T-Mobile. That's flowing through and it's helping to boost the service revenue. I think over time, they're adding in those little extras like, device insurance and perks like, added content that you can purchase at a discount through Verizon. And I think all that together is going to continue to provide a lift to service revenue. It's nothing special. Again, I'm looking forward to that Frontier acquisition where they're going to buy access to 2 million fiber broadband subscribers and 8 million fiber homes passed, because once they get Frontier under the hood, they're going to be able to bundle their wireless service with fiber. And I think that's going to help to really drive renewed subscriber growth.
Our thanks to John Butler, Bloomberg Intelligence Senior Telecom Analyst.
We move next to the toy industry.
This week, the toy maker Hasbro reported second quarter earnings that beat analyst expectations.
The company also said it's raising its full-year outlook. This comes after a record quarter for Hasbro's Magic: The Gathering card game.
For more, co-host Isabel Lee and I were joined by Lindsay Dutch, Bloomberg Intelligence Consumer Hardlines Senior Analyst. We first asked Lindsay to break down what we learned from Hasbro this week.
Strong quarter, really a continuation from the first quarter, where all of the strength is really coming from Magic: The Gathering, Monopoly Go, and Hasbro's digital gaming business. What we did not learn from the release is really about the consumer and what the outlook is for toys in the second half, and that's causing a lot of uncertainty, what that back half might look like.
I was going to ask, how exposed is Hasbro to current consumer spending trends, like especially in the toys and entertainment area? Do we see more middle-income shoppers buying Hasbro, or what kind of consumers are you seeing?
Yeah, so the toy business typically grows with GDP. It has been, coming down a bit challenged over the past couple of years after the peak during COVID when everyone was stuck at home buying a lot of toys. This year was supposed to be a turnaround year for toys. And then early this year, we got hit with the tariff news, which created a lot of uncertainty in the business. One is, we don't know how the consumer is going to react to broader price increases, and we do expect increases on toys very specifically. So companies like Hasbro and Mattel, some of the biggest toy makers in the globe, are really faced with that challenge. In second quarter, normally retailers already start buying their holiday inventory. That didn't happen this year. Those retailers, Walmart, Target, took a pause. So normally by now we would sort of get a sense of holiday, but because of that pullback, Hasbro saw their consumer products segment see a 16% decline in second quarter revenue because of that hold on those orders.
I would have thought they would have tried to front run the tariffs here. What's the company saying about when they expect some of these retailers to place their orders?
So they expect the orders to be sort of made up in the third quarter. And the challenge with that is, some of those hotter toys that do sell out, maybe in the early holiday shopping season, there will be very little time to sort of replenish on that end. So Hasbro did continue their production, which, they do still make about 50% of their toy products in China. They continued in May. They took some of that inventory on their books in the second quarter. That's why we saw the inventory come up there. They're hoping that the retailers, place more of their orders in the third quarter, ahead of holiday. The risk is they just don't really know what those pre-order will be, and there will be limited time for additional orders like in that fourth quarter right before holiday.
to your point, in April, the company warned that tariffs could impact profits by as much as 60 million to 180 million this year, and they did reduce their Chinese manufacturing output to less than 40%, or at least plan to by 2026. If they do that, will they pass on the cost to consumers, and do you think consumers will bear the brunt of that burden?
Yes, so Hasbro is using multiple mitigation strategies. They have been very focused on cutting costs. Prior to tariffs, they sort of accelerated some cost cutting at the corporate level. They will be raising prices, I think, selectively on toys. They are also just going to not sell certain toys in the U.S. if it doesn't make financial sense to do so. If they can't raise the price and consumers would not buy it at that price. So they're sort of using a mixed strategy. They had predicted tariffs to cost 60 million to 180 million on an annual basis 3 months ago. They sort of dropped that impact closer to the 60 million side. That's because of the lower rate on the Chinese imports. They are working to diversify the supply chain, but that will take time. The goal of less than 40%, that's really by 2027. So in terms of this year, where their supply chain is, they're sort of locked in with that at the moment, and they kind of have to work with the price increases and sort of balancing where do I increase price and not hurt the demand even more.
Our thanks to Lindsay Dutch, Bloomberg Intelligence Consumer Hardlines Senior Analyst.
We move next to the hospitality industry. This week, the hotel chain Hilton Worldwide lowered expectations for net income for 2025, while U.S. hotel bookings declined in the second quarter.
And this comes as U.S. travel demand has faced headwinds in recent months, including lower consumer confidence and a decline in international visitors.
For more, co-host Isabel Lee and I were joined by Jody, Lurie, Bloomberg Intelligence credit analyst. We first asked Jody what we learned about Hilton from its earnings call this week.
I think what's so interesting is they definitely tried to provide an upbeat, optimistic view. The amount of times that they talked about the thawing that after the freeze from tariffs was sort of interesting to hear. And I think it fits a little bit with the conversation that we've been having with clients, is that what we've been seeing in our data is 2025 summer should still be pretty strong. But I think as we get into the latter part of the year and then into next year, it's a little bit uncertain. And I think they were trying to suggest that economic data is positive for them and will provide for additional sort of demand. But it's still a little bit, it's still a little bit hazy, at least for me. And more than anything, they're so focused on giving back to shareholders that.
And as a credit analyst, that's not something you necessarily.
Hilton's one of those companies that we say if they wanted to be investment grade, they probably could work to it yesterday and would have been investment grade 5 years ago. But from a margin standpoint, they're so much stronger than a lot of their peers. But from a leverage standpoint, they're happy being around 3 times, 3.5 times, and they've indicated that they want to be a little bit higher than where they currently are. So, I think they're going to invest in organic growth and look at ways to sort of grow some of their newer brands like Spark, which they've been talking about. And the most interesting thing related to that is it seems like they're looking outside the U.S. for growth opportunities. And maybe that's a function of the fact that while they think the U.S. is still having decent momentum, perhaps they need to sort of look outside to sort of really see the growth.
Where are they finding that growth elsewhere? And is that in relation to just the lower consumer confidence in the U.S. and the decline of international travelers? So then they just decided maybe looking elsewhere is better? What was the rationale behind that?
So they actually talked about on the first quarter, they talked about Canada and Mexico demand. And they said specifically that it's such a small percentage. It's like 1% of their total revenue is Canada and Mexico. And inbound U.S. is certainly a large portion, I think, larger than they sort of indicate. But I think they're also sort of saying, okay, yeah, it's going to be an effect, but it's not that much effect. I think they are seeing, and what we sort of heard on this most recent call, is that there is an element of trickle-down effect related to what's going on in the U.S., the prevalence of travelers coming into the U.S. versus historically because of the tariff and geopolitical environment. And so, they mentioned Saudi Arabia, they mentioned India, they mentioned Turkey on the call, and I think they're looking at anywhere there's potential growth opportunities. Hilton's so large and global that it's not really surprising to me, but it is sort of interesting when you hear a company that's 75% U.S. dominant that they are sort of looking to expand elsewhere.
Our thanks to Jody Lurie, Bloomberg Intelligence credit analyst.
Coming up, we'll look at how Elon Musk's recent political antics may be affecting his business empire.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Lisa Mateo.
And I'm Paul Sweeney. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Paul Sweeney.
And I'm Lisa Mateo, filling in on Bloomberg Intelligence.
Next, we turn to the auto sector.
This week, General Motors released second quarter earnings that beat analysts' expectations, but the carmaker said it still suffered a $1.1 billion profit hit from President Donald Trump's tariffs.
GM also revealed no plan for a near-term fix to return to pre-tariff profit levels. For more, Lisa and I were joined by David Welch, Bloomberg News Detroit Bureau Chief.
We first asked David, was he surprised by the $1.1 billion tariff hit?
Not surprised at all. GM said they were going to take a $4 to $5 billion hit, or at least that they had $4 to $5 billion in exposure this year to tariffs, and that they would only be able to offset about 30% of it. And the measures they're using to offset that, you really won't see till the second half. So I thought there would be a pretty big hit to it. I don't think the street was surprised either, because the forecast for GM's earnings were for a pretty big drop off of the second quarter of last year already. GM did better than that because they did have some things, better profits in China than we saw a year ago, and better sales in the US that helped them. But overall, pretty tough quarter, and it really shows that the car companies are going to have a tough time getting anything close to pre-tariff profits going forward, because there's just no easy way to get around them.
So, I mean, is what we're to take away from them is that the auto manufacturers, for whatever reason, maybe they're just not able to, or they chose not to pass along the bulk of their cost increases to consumers? Is that a policy, or is that just an economic reality?
It's an economic reality. And look, we're at a period right now where interest rates are at pretty high levels. You have historically, not record, but pretty close to record new vehicle prices in the U.S. right now. Average monthly payment, well over $700 a month. We have a record number of people, I think, paying more than $1,000 a month for their monthly payment. Cars are expensive. So, you can go out there and say, hey, I'm going to pass this tariff cost on to consumers, or even some of it. But if consumers don't pay it, then you just lose the sales. And you haven't seen huge price increases. You've seen small ones. You've seen companies sneak in, some bigger fees for transporting the vehicle, for example, things like that. But it's just not. They just don't really have the ability to push in big price increases to pass on, in GM's case, $1 billion worth of tariffs in a quarter.
And it's not just tariffs. What else affected profits for GM? I mean, how's their inventory for electric vehicles?
They built that up in the quarter, and since the vehicles lose money, they have to account for that. That cost them, I think it was $600 million in the quarter. They had $300 million because they've had a big engine recall, so they've had higher warranty costs. It wasn't just because of that recall. They've had other issues, and they're working on that. Some of these quality issues you're seeing that are costing companies more in warranty and recall type costs are all the software that goes into electric vehicles. These are kind of first times out with new software, new infotainment systems, power management systems in these vehicles. And it's just tough for them to go out there and not be buggy, right? Think about how many times there's something on your smartphone that needs an update, and fixing that with a car is often more expensive. So some of it was related to that, and actually, they saw pricing go down with some of their fleet customers. There's a lot of competition out there for the corporate and fleet business, and they actually saw some downward price pressure there too, and that cost them $200 million. So a lot of things in the quarter that pushed profits down, but tariffs are the real story here.
David, you're out there in Detroit. You live and breathe this stuff every day. What's the feeling in Detroit as it relates to this evolution to EVs, and how will the tariff and the tariff impact on profitability? Is that going to slow this down even more, do you think?
I do. I think everything the Trump administration is doing is really going to slow the EV transition. First of all, the obvious one is come September, they're going to be getting rid of the $7,500 tax break for qualifying electric vehicles. But with tariffs, you've got battery components, electronic components, wiring harnesses. There's more wiring in an EV than in a conventional vehicle. All that stuff adds to the cost of vehicles that already lose money. Some of them are actually built overseas. In the case of Hyundai, they make some of theirs overseas. GM makes a couple of its EVs in Mexico. They do qualify for USMCA, but there are still some parts component tariffs that they can be hit with on some of these vehicles. And so you add cost to vehicles that are already pretty expensive, and you can't pass it on. If you do, even fewer people will buy them. Companies may have less incentive to build and sell them if they lose even more money on these. So that's going to hurt as well. And then, of course, Trump's rhetoric for people who are politically right of center and pretty far right is that EVs are a dumb purchase and they don't work for you. And I think that hurts sales as well. So all of this is just not good for the momentum that EVs had in the U.S. Before Trump got in office.
Yeah. So, David, last month the company said it would shift some production to the U.S. from Mexico. So what other changes can we expect to see from the company?
I think you'll see them try to bring more of the parts they buy into the U.S. So they'll be encouraging their suppliers to do what they're doing, which is move some production to the United States, and that'll take time. And you may see them make some more production-related moves. What they've done is pretty big, so I'm not anticipating any big announcements. But as they look at this and they find other ways to do it, you might see more vehicles, more parts built here in the U.S.
Our thanks to David Welch, Bloomberg News Detroit Bureau Chief.
This week, we focused on a Bloomberg big take story entitled Elon Musk's empire is creaking under the strains of his antics. You can find it on Bloomberg.com and the terminal.
The story looks at the state of Elon Musk's companies, Tesla, SpaceX, and XAI, and it gives insight into how much Elon Musk's recent political antics are affecting his empire.
For more, Lisa and I were joined by one of the story's co-authors, Max Chafkin, Bloomberg Businessweek senior reporter and co-host of the Elon Inc. podcast.
We first asked Max if Elon Musk's political antics are impacting his business empire.
I mean, absolutely. And it's because as much as Tesla is a car company, it is, I think, for many investors, really an Elon Musk company. It's a way to bet on what they see as the singular genius of this guy. And as you said, over the last few years, it's gotten harder to see that. There have been challenges, and I think obviously the biggest challenge is this relationship with Donald Trump, where you had, in December, Elon Musk, helps get Trump elected and then is in this position of extreme influence, probably more influence than almost any, executive ever. And you had this kind of Trump trade where people were bidding up the stock based on the idea that Elon Musk was going to be able to get all of these policies that were going to help his companies. His companies, of course, very, very much enmeshed with the government and heavily regulated. And then we're seeing that in reverse. We're seeing what happens when you have a business and a bunch of businesses, in fact, that are heavily regulated, and you're in a fight with the most powerful person in the world, and Donald Trump.
You say in the article that really stood out to me, you say he is rich on paper, but he is cash poor. So kind of explain that to us, dig into that.
Yeah, I mean, part of this has to do with the fact that he's always making these big bets, but when you look at his wealth, it is mostly in Tesla stock and options. And he's running this empire, which, obviously includes Tesla. It also includes SpaceX. He's got a lot of SpaceX stock as well. Neither of those companies, he's able to borrow money against his positions in these companies. And we have seen sort of Company A buy equity in Company B, that sort of thing. But there isn't just like a huge pile of cash, and he has all these things he's trying to do. There's really only one company in the portfolio that is reliably profitable, and that's Tesla. And then you have SpaceX, which of course has a lot of promise and has a dominant position in the launch market, but is not necessarily throwing off cash. And so you have this empire that is very large, but where different companies are supplying things to other Elon Musk companies. And I'd say the most obvious example of that is this XAI XAI investment round, which is already, Elon Musk has already said SpaceX is putting $2 billion in. He's also indicated he's going to try to get Tesla to put $5 billion into XAI. And this is a company that is burning, $1 billion a month. Now, this is the kind of thing that for any other executive, it's like a conflict of interest on top of a conflict of interest. On the other hand, Elon Musk has this fan base that has so far been willing to kind of go along with things that no other investors in any other company would ever go along with.
Is there any reason to believe that the feud, to whatever degree it is at the moment, between President Trump and Elon will de-escalate?
Yeah, I mean, I definitely think that's possible, partly because both Trump and Musk, obviously they're both famously kind of alpha, very tough, but they also both, they forgive. Like people have made this observation about Donald Trump that, although there are a handful of people that are sort of permanently outside of the circle of trust with Trump, people fall in and out of love with Donald Trump, and he is able to kind of look past feuds. Elon Musk is the same way, and there is a mutual interest here. As I said, Trump kind of needs Musk because Musk was the most important financial backer for Republicans during the 2024 cycle. He could very well be the most important backer in the 2026 cycle, and I'd say that Musk kind of needs Trump, both from a branding perspective, from the fact that once you've alienated the entire universe of Democratic voters, which Musk kind of has done, then what do you have left? You have basically the Republicans, and you don't really want to be on the outs with Donald Trump as a cultural force. And then on top of that, you have the sort of regulatory issues. Self-driving, which is what Tesla is betting its future on, is a regulated industry. Rockets, government contractors. So there are all these ways that Donald Trump could either hurt or help Elon Musk, depending on what the relationship looks like.
In the last minute or so we have left, it seems like someone else is kind of sliding into that position. OpenAI, Sam Altman, is he kind of taking over where Musk left the spot? What do you think?
Incredible, right? Like watching that happen, especially given the fact that Sam Altman, former Democrat, of course, Elon Musk at times has supported Democrats as well, but Sam Altman much more recently was a Trump critic and so on. And that is, there have been a bunch of political sort of missteps made by Elon Musk, and that is, you'd have to include that in the list, just because Sam Altman certainly didn't have the pole position, and now OpenAI, this AI large language model company competing with XAI, is in a position of proximity to the president, and so that's yet another case where this feud is not helping Elon Musk.
Our thanks to Max Chafkin, Bloomberg Businessweek senior reporter and co-host of the Elon Inc. podcast.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.